So some of you may not know Spheria. We are an Australian small cap, microcap manager. So what we do is we invest in companies outside the top 100. I'm not going to put the boot into Telstra, unlike some of the peers. But what I will be talking about is some of the hype outside of the top 100, outside of the big companies. I think this is a very apt quote for the market at the moment, and we'll go into what we believe is the weighing machine shortly. What we're seeing in the market is a battle at the moment. It's a popularity contest, and there's the haves and the have-nots, particularly in the small cap space. If you're a have, you've got a massive market capitalisation at the moment. You probably have no earnings, you're probably burning cash. That to us is pretty dangerous. The have-nots actually, some of them have great track records. They're just not popular because they're not going up. And that's where we think the opportunity in the market is, in the small cap space. Now, just moving forward, how do you measure, how do you assess the substance of a business? And what we get down to is cash flow. And when we talk about cash flow, we talk about free cash flow. So it's not some EBITDA number, some adjusted profit number. What we're talking about is a company's ability to generate free cash flow. That's after all costs, all capital expenditures, basically everything. Now, a lot of you probably have your own business. You probably look at your P&L. You don't talk about EBITDA. I think you probably look in the bank account and see how much cash comes in every month or every year. That's what we're looking for. So when we do an assessment of a company, we're looking for the free cash flow that it generates. Now, what's the voting machine? Well, the voting machine is the hype out there, and there's a lot of hype, especially in the small cap market, and in particular the microcap market. At the moment, it's all about price momentum. Stock's going up, it's good. Stock's going down, it's bad. I mean, to us, that doesn't end well. What we want to do is find a company that can generate good, sustainable cash flow through the cycle. But you also need to value that cash flow. You can't pay too much. Valuation does matter at the end of the day. Now, where we've seen this manifestation in the small cap market, there's a few ends to it, but there's the microcap end, where we're seeing a lot of overhyped microcaps. And we did an analysis at the end of January, and we looked back at, companies that had a market cap greater than 100 million and less than $2 million of revenue. So that's a pretty big market valuation for companies not really generating anything. They're pretty much concept stocks. What you can see is if you look back on that left chart back to 1993, we had a peak in January. There were 52 stocks in the universe which met that characteristic. So they're pretty much concept stocks with big valuations. Now, since January, since we ran this analysis, we took a sample of those companies. The actual index of stocks has fallen 50%, so you've halved your money. So you're already starting to see some of that speculation come out of the market. If you look at some of the names, the names are a deterrent in itself. Biggin, Yogi, GetSwift, all these companies that just had cool names but no business. So what you're seeing is a real downdraft in that microcap end of the market. So we've avoided those sort of companies. Now, the other part of the market where we're seeing, I suppose, overvaluation is some of the market darlings in the sector. So these companies have re-rated aggressively. Now, I put Credit Corp up there because it's got an interesting history. So Credit Corp is a debt collector. They buy debt basically from the banks, and they go out and collect that debt, from households basically. Now, pre-GFC, they bought a lot of debt ledgers. They paid big money. They went into the US market. They consumed cash. Now, we don't own Credit Corp. They did that. The stock actually went ballistic. It went to $20 pre-GFC. Now, the GFC hit, and what happened is they found out that they paid too much for the debt ledgers. They couldn't collect. Suddenly, the cash flow turned very negative, and they actually had to stop buying ledgers, and the share price collapsed from $20 to less than $1. Now, at that point, they changed the whole strategy. They actually said, hey, instead of buying debt ledgers, we'll actually harvest them. Now, if you look at that chart on the left, you can see the dark blue is the free cash flow generation each year, and the light blue is the EBIT, so the earnings before interest and tax. And that's how we test the earnings. We look at the cash flow relative to it. Coming out of the GFC, they decided to collect cash. They did the right thing. and actually became a good play. It was a good investment. Now, the stock went from less than $1 and it's rallied back to $20 again. But what's happened in the last few years? They've gone back to their old mantra. They've gone back and they've started buying debt ledgers again aggressively. Now they've got to harvest those debt ledgers. And if you look at the returns on the right side of the chart, you can see the return metrics are declining. The actual business fundamentals are deteriorating. But if you looked at the share price of this company, it's only headed one way. So these guys are buying earnings. Now the cash flow is actually deteriorated. We think at some point there's going to be a deterioration in the share price. Now moving forward to a company which we really like, it's called TechnologyOne. You may not have heard of it. It's one of the quiet achievers in the Australian market. It's probably one of the best tech companies in this market. It provides enterprise software to basically councils, government departments, hospitals, tertiary institutions. And it's actually the dominant player in the market. You would think that a US player would be the dominant player. These guys compete against SAP, Microsoft, Oracle in that space, and yet they've got dominant share. This company was basically built out of a garage in the early 90s. It's an amazing occurrence. But why do they do better than their peers? One of the reasons is they actually do the consulting and they do the implementation of their product. Their global players don't do that. They basically outsource that to third parties. Now, that's a higher cost model for TechnologyOne, but in doing that, they win a lot of clients. And if you look at some of their verticals, they are the dominant player. So councils, for example, there's 547 councils in Australia. They have over 300 councils on their system. It's pretty amazing that they've got that sort of share versus their peers. So they're getting greater scale as they grow. And if you look at that chart on the left, you can see that cash flow conversion in the business. Cash flow is a key driver of value in our view. And you can see that over 20 years, this company's had amazing cash conversion relative to its earnings. Now, if you look to the right, that just shows the revenue of the business and how much is now coming from SaaS, subscription type revenue. So it's more predictable revenue. They're currently around 55% subscription. That will go to 70% over the next few years. Most of the clients are moving to the cloud. The cloud is a SaaS model. So the actual predictability of their revenue is improving. The scale of the business is improving. But if we actually roll forward, the chart on the left shows that the actual share price has been under pressure. And we think it's provided a massive opportunity in one of the best tech companies in Australia. The market is just seeing this company as unpopular at the moment. What's happened is there's some new accounting rules which will change the way that this company reports earnings. But to us, it doesn't matter because we know the cash flow is there. It doesn't matter whether the EBITDA is down and the capex is up. We know that the cash flow is always going to be there. So what you've seen recently is a big retracement in the stock. If you look back historically, in 2000, this stock traded at 50 times EBIT, so effectively 50 times earnings. It would take 50 years to get your money back if it did not grow its earnings. But the company actually grew its earnings and it was pretty much uninterrupted growth. If you look at the right chart, you can see the shaded grey area. This company's had enormous growth in earnings from less than $10 million to $80 million of EBIT. So it's grown. And if you had bought it back then at 50 times EBIT, you would have said, and you had known it was going to grow like that, you would have thought, I would have made some money. It actually took 12 years to recover from that high in 2000. So what this goes to show is that if you pay too much for a company, even a good company, you can get it wrong. So our point is that valuation matters. Recently, we've taken a big position in this company. So the company, you can see if you look at that left chart, it's back to 20 times EBIT. So it's a 5% free cash flow yield. To us, that's pretty good for one of the best tech companies in the market. Now, it might get cheaper for some reason. If it gets cheaper, we'll probably buy more. Now, just moving forward to the next one, what we've seen in the small Ordinaries index is a small pocket. The top 15 stocks in the actual index have had a massive re-rate. You can see it here, that yellow line. They've gone from a 35% premium to 133% premium relative to the index. So if you own those top 15 stocks, you've nearly doubled your money, basically. If you didn't own them, it was a pretty tough time. Most of the other stocks have just treading water. Now, we were lucky. We owned one of those companies. Maybe it was good management more than luck, but we're a bit lucky there. We bought a company called Certex. And why did we buy Certex? The share price a couple of years ago got to $30, $40. All the blue sky was factored in. They've got a liver cancer treatment. And then they had some disappointing trials. And the share price fell away. It got down to $12. At $12, it was generating $70 million of free cash flow. It had $120 million in the bank. And the penetration rate of its product was single digit, and it was growing. But the market was a bit disappointed with trials, sold it off. It was trading at 10 times earnings. Now, we bought that because we thought this is a global leader. It's effectively a duopoly market. It was a treatment that was going to take market share. Now, what transpired is that stock was taken over earlier this year for $28, and then there was a second bid for $33.60. So we made money out of it, but we didn't make money buying it when all the blue sky was factored in. We actually made money when it became cheap enough for us to enter. And it was, again, it was a have-not. It wasn't a have, it was a have-not. And that's where you often find that you can make money. Now, that re-rating story has actually happened. If we wound back to 2000, 2001, and I was a young sell-side analyst at the time, I covered Computershare, it got to 250 times earnings. So it got to a massive multiple during that time. And a lot of people have forgotten. There's a lack of corporate memory these days. CSL got to 94, Cochlear 93, TechnologyOne, which I just discussed, got to 58 times earnings. These companies are all fantastic companies, but everyone forgets that if you bought them at the wrong price, they actually fell a lot. Computershare fell 80%. CSL the same. Cochlear down 60. TechnologyOne down 80%. Now, the companies had a few hiccups, but it was nothing that dramatic. You just overpaid for the companies. So what you really need to be careful about is overpaying, we reckon. Now, if we roll forward to 2018, we've got a similar effect. I just talked about that top 15. You can see WiseTech, it's on 112 times PE. NextDC, 200. We don't own these companies, by the way. Hub24, 90, and Altium, 56 times. All good companies, but we think the market's overpaying. Now, we'll just patiently watch. At some point, we reckon we'll get an opportunity to buy some of these companies. Now, in saying that, there's another story on this table, and I think you can see it, that if you actually buy these companies at the right time when they're have-nots, you can make a lot of money. If you bought CSL after it fell significantly, it might have been 50% down, 60%, 70, 80, you could make a lot of money, a lot more. Computershare, all of them were good companies and they were going to grow again. You just had to be right in terms of when you bought them. Easy in hindsight, of course. Just rolling forward. In conclusion, what's our process about? Our process is that cash flow is king and that valuation matters. We think that we will be consistent through the cycle. We think our companies can self-fund through a down cycle. We think if we buy companies with good balance sheets, they can get through a down cycle. There is good opportunity in the market. There are a lot of unpopular companies which are actually good companies like TechnologyOne. Now, our amplitude of returns, we're not going to do 50% in a good year, but also we're not going to do negative 50% in a bad year. But if we can just be consistent and have less amplitude in our returns, then we think we can win the race. And it is a marathon, it's not a sprint. Thank you.